Our next guest warns that the economic fallout of the banking crisis, though, is just beginning, but also believes the economy has a fighting chance of avoiding a recession over the next 12 months, given the resiliency and what he calls reasonable policymaking. Joining us this morning, Moody's Analytics chief economist Mark Zandi joins us. Mark, it's great to have you. I'd like to get you on the banks first. This notion, we've heard it a couple different times, that the FRC episode likely ends the forced sale of banks because of deposit flight. Others say there are 4,000 of these things out there. How can we possibly know that? What do you think?
4,700 to be precise, Carl, in falling. I think the worst of it's over. I think the institutions that failed are very idiosyncratic. Their business models are just kind of outliers. And I think because of the pressure on the system, they failed. But we're now on the other side of that. I think it feels a lot better going forward. There may be other smaller banks that fail because the pressures are still quite intense. As long as the Fed's raising interest rates, that's going to remain the case. But I sense that the worst is over here. Yes.
How do you think this gets folded into the chair's commentary on Wednesday?
Well, if I were him, I'd explicitly acknowledge it. I mean, the financial system is under a lot of pressure. And by the way, it's not just the banking system. It's the non-bank part of the system, too, that's under a lot of pressure. And, as long as rates remain where they are, there's still the risk that something breaks there as well. So I think he's going to acknowledge it. I think he'll probably acknowledge it. And here, this may be more hope than anything else. I hope he uses it as a basis for telling everybody that this may be the end of the rate increases. I mean, obviously, it depends on the data between now and the next meeting in June. But given the way things are unfolding here, that and the banking crisis, that the terminal rate, the highest the rate's going to get in this cycle is here at just over 5% on the funds rate.
And Mark, we're heading into the meeting on a run of a little bit firmer than expected economic data. So you can kind of make the case that the broad economy has held together, maybe a little bit better than anticipated. And then you have that judgment call of trying to quantify the effect of a credit contraction. And of course, you have still this pricing in the Fed funds futures market suggesting that there's a downside to rates likely later in the year, or at least that's where the probability spectrum brings you. Do you think the economy is truly more resilient than anticipated? And what is that going to mean for how, I guess, the market takes a higher for longer message?
Well, Mike, it's not stronger than I anticipated. I mean, I think it's kind of threading the needle here, right? I mean, it feels like it's growing, but it's growing well below its potential. So that means that parts of the economy are in recession. In today's ISM manufacturing survey that you just mentioned, that's below 50, so that signals contraction, recession. Housing's in recession. And I suspect other parts of the economy here are going to start sinking. Commercial real estate would be another good example. Small businesses are going to be under a lot of pressure because of the restrictions on credit related to the banking crisis. So, but this feels like it's this kind of threading the needle exactly where you want it to be to get to quell the inflationary pressures, but to avoid an economic downturn. Obviously, a lot of script to be written here, and a lot of things could still go wrong. But at least so far, it feels pretty good.